Hey everyone, welcome back to Corporate Decoder. Get ready, because this financial report from Solitron Devices is a bit like that surprise guest at a party who makes things awkward, but hey, at least it will be interesting. We're diving into their latest financial report, aka their 10Q. Let's try to see where the company is headed. Before we jump in, if you're someone who likes getting real insights from financial documents, hit that subscribe button. Plus, we have a Discord community linked in the description where you can discuss this and other reports with fellow finance enthusiasts. First, a quick overview of what we'll be looking at. The report includes the financial statements, which are like a snapshot of company records, management's discussion, and analysis where the company tries to be positive, information about risk, and some other legal details. Let's get into the numbers, starting with their balance sheets, which show what the company owns and owes as of a specific date. We're comparing May 31st, 2025 to February 28th, 2025. First big number, cash and cash equivalents. Basically, how much ready money they have. It dropped from about $411 million in February to $226 million in May. That's a pretty noticeable decrease. If we look at the big picture, total current assets, which includes things like cash, accounts receivable sales that haven't been paid yet, and inventory, decreased from $7 million to $80 million. This is important. It means that overall they have less short-term assets. Zooming out further, total assets, which includes everything that they own, went from $24.4 million to about $24 million. On the other side, their total liabilities, which means what they owe, didn't change that much, staying around the $655 million range. Looking further, we see that the retained earnings, which is basically profits that were kept by the company, went down from $17.4 million to $17.1 million. The company's total liabilities and equity is important because it needs to match the total assets, ensuring the accounting is correct. Went down from 24 tiny dollars all of 44 million to 23.9 million. Now let's check out the income statements, which tells us how much money the company made or lost over a period of time. Again, we're comparing 3 months ending May 31st, 2025 to the same period last year. Their net sales, the total revenue after returns and discounts, decreased a lot from $39 million last year to $27 million this year. That's a big drop. Interestingly, their cost of sales, which refers to how much it cost them to make the products, didn't change. It went from $230 million to $231 million. Gross profit is revenue left after they pay for production. We see that profitability took a hit, with gross profit falling from $1.6 million to just $390,000. Lower sales combined with similar production costs squeezed their profits. Selling, general and administrative expenses, those decreased slightly from $883,000 to $768,000. The end result, net income, tells you how much money the company actually made after all expenses and taxes. And here the company flipped from a profit of $500 to a $36,000. That's a concerning switch, which is due to reduced earnings. Now let's look at the cash flow statements, which show the actual cash moving in and out of the company. The net cash from operating activities tells us how much cash the company generates from its regular business activities. This decreased for $714,000 last year to $714,000 last year. To $391,000 last year to $391,000. There was also a use for cash and investing of $1.8 million. Moving onward, in the financing section, we see a payment for the mortgage loan of $37,000. This number last year was in the positive $1.3 million. Ultimately, we see that the cash and cash equivalents decreased by $1.5 million at 100. The company had $137,000 in increase of cash last year. Solitron Devices mainly makes solid-state semiconductor components and related devices, mostly for the military and aerospace industries. They've been around since 1959. Recently, they also acquired a company called Micro Engineering in 2023. They use standard accounting principles. They have to estimate things like how much their inventory is worth or how much of their deferred tax can be used later on. They may use different estimates than what they use, which might affect their results. The company's investment in marketable securities, basically stocks and bonds they can easily sell, stood at $659,000 near the end of May. Most of these are in common stocks. They also invested in a non-current securities, meaning they plan on holding the investment longer than a year, which consists interest in an investment fund. The cost was $1.65 million. The company values its assets and liabilities based on what they could be sold for in an open market. They use a 3-level systems for that valuation. The accounts receivable, which is uncollected sales, are monitored and have an allowance for losses. The shipping costs are billed to customers and recorded in net sales. Inventories are valued at cost or market value, whichever is lower. They buy raw materials to fill orders, and excess material is reserved for if it is not used in 2 years. Property is recorded at cost and depreciate over a life of 39 years to 3 years. The company places its cash in high credit quality situations and performs ongoing credit evaluations. The company records revenue when they ship the product to customers, aka point in time. Also, the company counts for sale returns and allowances, which is subtracted from revenue. We take a look at the sales and allowances chart. You see that return allowances began at $310,000 and ended at $292,000. Let's go further to the total inventory numbers. $1.8 million for raw materials, $1.3 million for work in process, and $436,000 in finished goods. The total expenses for payroll, taxes, property, rent, etc. is at $857,000, a slight increase month over month. Here is the revenue breakdown: $33,000 in Europe, Australia, $11,000 in Far East and Middle East, and $2.6 million in United States. They had nothing in Canada and Latin America. Lastly, let's check out suppliers. The purchases come from 2 suppliers, 57% and 25%. The company does not have any known material, current, pending, or threatened litigation. Mortgage is $3.80 and $80.80. The board of directors authorized an increase in the company's stock repurchase program of up to $2 million. The company didn't repurchase any shares. From all this, we see that Solitron acknowledges that the first 3 months of 2025 sales dropped compared to 2024. However, orders for the next months are up by a large margin, 94%. Our CEO and CFO concluded that new disclosure were appropriately designed but weren't in effect in that period. Now, putting all this together, what do we see? Solitron Devices appears to have hit a rough patch. Sales are down and it flipped to a loss, and cash reserves that are important for the company decreased. One thing is their major customer concentration, as a big chunk of their revenue comes from a few clients. If they were to lose even one of those accounts, that could create even more problems down the road. But not everything is bad. New orders seem strong, and as mentioned before, it's now 94% higher than last year. So looking ahead, what can we learn? Solitron Devices needs to focus on diversifying its customer base and improving its operational efficiency. Alright, that's our breakdown of Solitron's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.